Well, joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. Again, we are seeing oil prices hitting a three-month low, certainly a continuation of that price story. This weighing on energy players and also those broader markets. I'd just love to get your check on today's trade.
Yeah, you know, the way I see it is like right now the market is actually taking it all in stride. Let's keep in mind, oil opened the year in the mid-50s. It's been in a very volatile but tight trading range until very recently, down 2% today, down $47 a barrel. Yeah, it is true that energy stocks, airline stocks in particular, being affected by this, but the broader market seems to be taking this in stride right now, more so than they have in a long time. I mean, let's keep in mind, last week was the first time that the market actually reacted to a non-draw in the inventory report. There's been 9 weeks without a draw, and nobody seemed to care, and so now everybody seems to care. But with that said, right now, presently, the market seems to be looking the other way with regards to oil prices.
Certainly the key focus also, we are watching that volatility index really sliding to non-existence, really, and trading volumes remaining very light. The double barrel of not only Storm Stella keeping many at home, but also naturally the U.S. Federal Reserve in focus. A lot of investors appearing to be staying on the sidelines ahead of that meeting.
Yeah, absolutely. I mean, it's not just the Fed. We have the Bank of Japan, the Bank of England, CBRT. There's a lot going on this week, and just also with the politics. It is true the S&P 500 is off about $8 today, but let's put it in perspective, and that's basically where the S&P was before President Trump addressed Congress February 28th. I guess what we'd have to really worry about is if the S&P should retrace the phenomenal move when he came out with the tax plan or talk of the tax plan, and that would be about 65 points lower than here. But right now, yeah, volumes continue to be very muted. The combination of this winter storm along the Midwest and Northeast and also the slew of bank reports this week.
But Larry, when it comes to, I guess, sentiment among those traders over there in the U.S., are we seeing some sort of a shift of focus ever so slightly, I guess, from monetary policy rather to fiscal policy?
Well, I don't think we see traders focusing on that. I think the smart ones should be and are focusing on that, but I don't think that has hit like pedestrian headlines yet. I mean, that's what's really driving growth, because we have to keep in mind that the overarching themes that got us into this mess in the first place really have not changed that much, whether it be overcapacity, over leverage, or a changing workforce. So what is changing is we're fleeing away from monetary policy, and we have been for a while, and people are accepting that, but realizing that what's going to dictate private sector is not private sector, but it's going to be fiscal policy. And I think the sooner that people realize that, the more profitable they will be in their trading.
So let's consider then, if we are looking at future market action, we are looking ahead to the U.S. Federal Reserve. I mean, what do we see as being the result from this? What do we see the market response being? I mean, here at home, there's been some suggestions that when it comes to our local currency here, the Australian dollar, it could be hurt by the U.S. Federal Reserve. But is there a concern for the broader U.S. market?
Yeah, no, I think there is. But I think people have priced in that the Federal Reserve is going to be somewhat aggressive this year at raising rates. And I'm not sure why people are believing that, given the fact that they've said that 2 years in a row, and 2 years in a row they haven't been able to raise rates as much as they wanted to. It is true that our economic data is much sturdier and broader than it's been in the past, but I do believe that people are just getting ahead of themselves with regards to Fed hikes. And yeah, the broader market is being affected. We're seeing the dollar overshooting as it always does, and the long end of the curve rate going a little bit higher than it probably should right now.
We are seeing, when it comes to the precious metal space, gold steadying ahead of that expected U.S. interest rate hike as the U.S. Federal Reserve meets. But we've also seen weight in some of those base metals also weighing on the mining space, not only in the U.S., but also on that session in London also. But you, in fact, my understanding, Larry, you've actually raised your outlook when it comes to the base metals.
Yes, no, I have. And I think, the rally we saw last year in the base and industrial metals definitely caught everybody off guard, me included. I mean, this furious rally. And I think that points to the fact that there was a recovery coming along. And with that said, when I look at something particular like aluminum, for instance, up 20% in the last 52 weeks, people think it's going to normalize. I look the other way and say smelting capacity, especially in China, has gone down a lot. And to me, that's a bullish indicator to buy any weakness. When it comes to iron ore, up 78% in the last 52 weeks. It has backed off a little bit, and I think it still will back off a little bit. However, I don't think we're going to see the price down as fast or as furious as some people are guessing, just given that it's rallied so far. But I do think that it's going to continue to normalize over the next month or two.
So what do you see as being some of the price targets then with that in mind?
Well, I think right now iron ore is going to be stuck in a really tight trading range, but I do believe we're going to see up 10% from here by the end of the year. And a lot of it is just people still misunderstanding the rally we had last year, thinking it was just some kind of short covering rally, when in fact the backward-looking industrial numbers, especially PMIs, are showing growth, especially in the emerging markets. So I think there's going to be a squeeze on iron ore, not to the extent of last year, but I do think we'll see something 10 to 15% higher at the end of this year.
Interesting to note with that in mind. I mean, your expectations certainly lining in with the broader consensus that iron ore prices at the level that they have been, at the peaks that they have been, are unsustainable, and certainly expecting to see somewhat of a downward correction. Andrew Forrest, the chairman of Fortescue Metals Group, saying that while he does expect iron ore prices to continue their retreat from a 2.5-year high, he's saying that the decline shouldn't alarm the industry. Would you agree with that commentary?
Yes, absolutely agree with that. And by the way, I don't think that's the consensus here in North America. I mean, Australia obviously knows a lot more. It has the best iron ore traders around. But yeah, here in America, I think people think it's going to retrace a half, 2/3 of the rally from last year. I don't think that's in the cards. And I think if we get one of those free falls in the price, that'd be a good buying opportunity, because the information, the data is showing it, that the emerging markets in general are using a lot more. The PMIs, which are backwards looking, are showing industrial production in the right direction. So yeah, any price weakness would be constructive.
Certainly. Also, we had that commentary from Andrew Forrest up on screen just a moment ago, also flagging when it comes to steel consumption, certainly flickering across all of Asia, and seeing signs right here in Indonesia of much stronger steel demand, the chairman also said, which again, I guess, feeding into your broader outlook for the Asia market also.
Yeah, and so actually last week I went from normal weight to overweight in the emerging markets, but particularly in Asia. I mean, I really do like China in particular. That's my number one, followed by the Philippines. But I do believe that credit conditions there have improved considerably. I do believe that the dollar has overshot. I don't think the dollar is going to be the overhang to some of these emerging markets that some people were afraid of. And that combined, the markets have fallen so far so fast. I think it'd be a really good time to get into those markets, especially into China.
Larry Shover, we will leave it there. Thank you, as always, for your time. A pleasure to have you with us.
Thank you.